Gary Hutchinson was 67 years old, and he had done everything right. He and Sandra lived in Scottsdale, Arizona, married 38 years, 3 adult kids. Gary had maxed his 401k every year he could, sat on a non-qualified annuity he'd been growing since 2001, and had a brokerage account with stocks he'd held since the 90s. Total, just over $1.3 million. He wasn't wealthy by Wall Street standards. He was exactly what financial advisors call a successful saver. Everything built, everything documented. Sandra named as beneficiary on every account. Gary died in March of 2023. Sandra did the right things. She called the plan administrator. She rolled Gary's 401k into her own IRA. A smart move. One that gave her more time before she had to take distributions. She felt under the circumstances that they had prepared well. What Sandra did not fully understand, what no one had sat her down and walked through before Gary died, was what was going to happen to her children when she was gone, and what was already happening to her on the day she filed her first tax return alone. There's a gap between what people think they're leaving behind and what the IRS actually takes. And for most couples who save the right way, retirement accounts, annuities, investment portfolio, that gap is enormous. We're going to walk through 4 specific assets today. For each one, I'm going to show you exactly how the tax hit lands and the move that could have changed it, a move that only works while both spouses are still alive. The lawyers want me to remind you this is educational, not financial or legal advice. Treat it like a warning because that's what it is. And the specifics go to a professional who actually works for you. And if this is the kind of thing no one is telling your friends, share this video with them because it should not take a funeral to learn this. Now, let's go back to Sandra. Before we get into the 4 assets, I want to be clear about something, because I see a lot of retirement content that leads with estate tax. And if that's what you're worried about, I have good news and I have bad news. The good news, in 2026, the federal estate tax exemption is $15 million per person, $30 million for a married couple with proper planning. If your net worth is under that number, Paul Burnett and the overwhelming majority of people watching this are nowhere near it. You do not owe $1 of federal estate tax. That fight is not yours. The bad news, the tax that is coming for your family is quieter, it's slower, and it hits harder than most people realize. It's not estate tax, it's income tax, ordinary income tax, the same kind that comes out of a paycheck. And it doesn't come for your estate. It comes for your children every year, for 10 years after you're gone. And then there's the other hit, the one that doesn't go after what you leave behind. It goes after you, the surviving spouse. Starting the day you file your first return alone, the IRS restructures every bracket, every threshold, every deduction around a single filer. Same income, same Social Security check, same Medicare. One person died, and suddenly none of the numbers work the way they used to. That is what this video is actually about. Not estate tax, not probate. The income tax machinery that kicks in the moment a spouse dies, and the 4 assets that feed directly into it. If you have a traditional IRA, a 401k, a non-qualified annuity, or a taxable investment account, you are in this video. That's most people who spent 30 years saving the right way. And the window to change what happens to those accounts is not after the funeral. It is right now, while both of you are still here. So let's start with the biggest one. Here's something most people do not know about the account they spent 30 years building. When Gary died and Sandra rolled his 401k into her own IRA, she made the right call. The IRS allows the surviving spouse to do that, to step into the account as the owner, not as a beneficiary. Her RMDs don't start until she hits 73. She gets to keep deferring. That escape hatch is real, and it matters. But here's where the story changes. When Sandra dies, when her children inherit that IRA, that escape hatch is gone. Permanently. Because her children are not her spouse. They are non-spouse beneficiaries. And for non-spouse beneficiaries, Congress rewrote the rules in 2019 with the Secure Act, and the IRS finalized the details in July of 2024. The rule is this: every dollar in that inherited IRA must be distributed within 10 years of the owner's death. The account cannot sit and grow. It cannot be stretched over a lifetime. 10 years, and then it's empty. Now let's do the math out loud, because this is where most people's faces change. Say Sandra's IRA is worth $500,000 when she passes. Her eldest daughter inherits it. That daughter is 51 years old, still working, earning $100,000 a year. Under the 10-year rule, she needs to pull roughly $50,000 out of that IRA every year. Every dollar of it is ordinary income, taxed exactly like a paycheck. So now she's not earning $100,000. She's earning $150,000. She has just been pushed into the 24% federal bracket, potentially the 32% bracket depending on her state and deductions. And that happens every single year for 10 years. You thought you were leaving your children $500,000. What you were actually leaving them was a $500,000 tax obligation, paid in installments, one per year, for a decade. The IRS collects before your kids see a dime of real value. And here's one more thing: the July 2024 IRS regulations made clear how something that caught a lot of advisors off guard. If the original account owner had already started taking required minimum distributions before they died, the heirs don't just have the 10-year deadline. They also have to take annual distributions in years 1 through 9 on top of clearing the account by year 10. Miss one of those annual RMDs, and the penalty is 25% of the amount you were supposed to withdraw. It used to be 50%. Secure 2.0 brought it down to 25%, or 10% if you catch and correct it within 2 years. That is still a quarter of whatever was missed before the ordinary income tax on top of it. If you have a traditional IRA or 401k right now, I want you to do something. Think about the balance. Now imagine that balance hitting your children's tax returns in annual chunks for 10 years, stacked on top of whatever they're already earning. Drop that number in the comments. Just the approximate balance. I want you to actually sit with what that number means through your children's tax bracket, not yours. Now, there's a move that eliminates this problem, or at least shrinks it dramatically. It has to be done while you are alive. And I'm going to show it to you in full after we get through the next asset, because asset number 2 might actually be worse. And it catches people off guard precisely because they think they already understand how it works. Most people believe, reasonably logically, that when an asset passes to a beneficiary at death, the taxable gain resets. The IRS looks at what the asset was worth on the day you died, and that becomes the new cost basis. Your heirs start fresh. No capital gains on everything that built up over your lifetime. That rule is called a step-up in basis. It is one of the most powerful wealth transfer tools in the entire tax code. It applies to stocks. It applies to real estate. It applies to most things you own. It does not apply to annuities, not even a little. Annuities are one of the only assets in America where the step-up in basis does not exist at death. Every dollar of growth inside that contract, every year of compounding interest, every gain that accumulated while you held it is ordinary income to whoever inherits it. The IRS does not care that you held it for 22 years. The IRS does not care that you already paid taxes on the premium you put in. The growth is ordinary income, full stop. Let me show you what that looks like with Gary's annuity. Gary purchased his non-qualified annuity in 2001 for $100,000. By the time he died in 2023, it was worth $280,000. His original premium, $100,000, comes back to Sandra's daughter tax-free. That's her basis returning. But the $180,000 of gain, that is ordinary income, all of it, in the year she takes the distribution. At a 24% federal rate, that's $43,200 to the IRS before her state adds its cut. In a state with a 5% income tax, add another $9,000. Over $50,000 in taxes on growth that had been sitting in that contract for 22 years. And here's where the 50% framing in our title becomes real, and not as a statutory rate, but as a lived outcome. On a large non-qualified annuity, when you combine federal and state ordinary income rates and stack them on top of a beneficiary who is already earning income, the total tax bite on the gain portion can approach half, sometimes more. That is not a scare figure, that is arithmetic. Now, there is a move available to the surviving spouse that Gary and Sandra never discussed. When a spouse dies and leaves a non-qualified annuity, the surviving spouse has an option called spousal continuation. Instead of taking a lump sum distribution, which would trigger the full ordinary income hit immediately in 1 year, the surviving spouse can step into the contract as the new owner. The tax-deferred status is maintained. No immediate taxable event. The annuity keeps growing, and Sandra controls when distributions happen and how large they are. That option exists only for the surviving spouse. The children do not get it. Once Sandra is gone, whoever inherits that annuity faces the full ordinary income hit with no deferral option available. So if you have a non-qualified annuity and your spouse is still alive, spousal continuation needs to be written into your plan before anyone signs a death certificate, because after that, the window is closed. Now I want to get to asset number 3. And this one depends entirely on which state you live in. Two couples with identical portfolios, identical income, identical everything. One keeps the full step up, the other loses half of it. The difference is a line on a map. And if you're on the wrong side of that line and you don't act before one of you passes, your children could owe capital gains taxes on money that was never even theirs to begin with. I want to tell you about a rule that most people in common law states have never heard of, and that most people in community property states take completely for granted without understanding why it matters. It's called the step up in basis. We touched on it with the annuity, the rule that resets the taxable gain on an asset when the owner dies. For most assets, that reset happens at death, and the heir starts with a clean slate. No capital gains on everything that built up over a lifetime of holding. Here's what most married couples don't know. Whether you get a full reset or only a half reset depends entirely on the state you live in. There are 9 community property states in this country: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. In those states, assets accumulated during a marriage are considered equally owned by both spouses under the law. And when one spouse dies, the IRS applies the step up to the entire jointly held asset, both halves. The surviving spouse could sell everything the next morning and owe zero in capital gains. Every dollar of appreciation gone from the tax calculation legally, permanently. Sandra was in Arizona, which means when Gary died, their brokerage account, $340,000 in stocks they'd held since the 90s, originally purchased for around $80,000, received a full step up on both halves. Sandra could have sold the entire position the week after the funeral and paid no capital gains. Not because of a loophole, because Arizona is a community property state and the tax code rewards that. Now let me show you what happens to the exact same couple living in Ohio. Same portfolio, same $340,000, same $80,000 in original cost basis. Husband dies. Under common law rules, which apply in 41 states, only the deceased spouse's half of the account steps up in basis. His half, $170,000, resets to fair market value. Clean. But her original half, her $40,000 of original basis on her share of the account, stays exactly where it was. $40,000 of basis on a position now worth $170,000. When she eventually sells, she owes capital gains on $130,000 of appreciation on her own share of an account she co-owned for 30 years. Same portfolio, same marriage, different state, completely different tax outcome. Now here's where it gets interesting. Because if you're sitting in a common law state thinking there's nothing you can do about this, that is not entirely true. 5 states, Alaska, Florida, Kentucky, South Dakota, and Tennessee, now allow married couples to establish what's called a community property trust. It's a legal structure that gives you the double step up, even if your state isn't one of the 9 traditional community property states. Both halves of your jointly held assets reset at the first death. The capital gains exposure your surviving spouse would have carried or such gone. The catch, it has to be set up while both spouses are alive. This is not a document you file after the funeral. It requires an attorney. It requires proper titling of assets into the trust, and it requires time. If you're in Alaska, Florida, Kentucky, South Dakota, or Tennessee, and you have a taxable brokerage account with significant unrealized gains, this conversation with an estate planning attorney needs to happen this year. Not eventually, this year. And if you're not in one of those 5 states and not in one of the 9 community property states, then the honest answer is that the double step up is not available to you through this particular vehicle. What you can do is factor the capital gains exposure into your broader plan and make sure the assets that do get favorable treatment, like the step up on your spouse's half, are structured to capture as much of that benefit as possible. One more thing before we move on. The step up in basis survived the most recent major tax legislation. The One Big Beautiful Budget Act signed in 2025. There were proposals to eliminate or limit it. They did not pass. The step up is intact as of 2026, but that is not a permanent guarantee, and anyone telling you it will never change is not paying attention to Washington. Now, asset number 4 is different from the first 3. It is not something your children inherit. It is something that happens to you, the surviving spouse, starting the day you file your first tax return alone. And for a lot of widows and widowers, it is the most disorienting financial hit of their lives because nothing changed. Same income, same house, same everything. And yet somehow the IRS found a way to take more. I want you to imagine a woman named Carol. She's 69 years old. Her husband passed 14 months ago. She still lives in the same house. She still collects the same Social Security benefit. She still has the same Medicare coverage. Her income didn't change. Her expenses didn't change. Her life, in most measurable ways, looks almost identical to what it was 2 years ago. And yet, when Carol sat down with her tax preparer last April, her bill was thousands of dollars higher than it had ever been when her husband was alive. She didn't get a raise. She didn't sell anything. She didn't make a single financial move. One person died, and the IRS restructured every bracket, every threshold, every deduction around her new filing status. She didn't move into a higher bracket. The IRS moved the bracket to her. This is called the widow's penalty. It is not a conspiracy. It is not a targeted attack. It is the automatic consequence of the tax code being built around two filing statuses, married filing, jointly and single, with an enormous gap between them. And the moment a spouse dies, you fall into that gap. Let me walk you through exactly how it works, because the numbers are specific and they are jarring. When Carol and her husband filed jointly, their standard deduction was $35,500. That's the 2026 figure for a married couple where both spouses are over 65. The day she becomes a single filer, that deduction drops to $18,150, nearly cut in half. She didn't spend less. She didn't need less. The deduction just shrank. Now look at the brackets. As a married couple, the 22% federal tax bracket didn't kick in until their combined income crossed approximately $105,700. As a single filer, that same 22% bracket starts at $50,401. Carol's income hasn't changed, but the bracket threshold dropped by more than $50,000. The same dollars that were taxed at 12% last year are now taxed at 22% this year. And then there's Social Security. The thresholds that determine how much of your benefit gets taxed are not indexed to inflation. They haven't moved in decades. For a single filer, 50% of your Social Security becomes taxable once your provisional income crosses $25,000. 85% becomes taxable above $34,000. As a married couple, those thresholds were $32,000 and $44,000. When Carol dropped to single filing status, more of her Social Security benefit became taxable, even though the check amount didn't change by $1. And then Medicare hits. IRMAA, the income-related monthly adjustment amount, is the surcharge the federal government adds to Medicare Part B premiums when your income crosses certain thresholds for a married couple filing jointly. That surcharge doesn't kick in until modified adjusted gross income hits $218,000. For a single filer, the threshold is $109,000, exactly half. Carol has $120,000 in income. As a married couple, she and her husband were comfortably under the married threshold. The day she files single, she is $11,000 over the single threshold. Her Medicare Part B premium jumps from $284.10 a month to the next IRMAA tier. That is not a small number over 12 months, and it happens automatically. Nice passage, no appeal, no warning, just a letter from Medicare telling her her premium went up. There is a 2-year grace period the IRS provides called qualifying surviving spouse status. For up to 2 years after a spouse's death, if you have a qualifying dependent, you can still use the married filing jointly brackets. But most widows and widowers don't have a qualifying dependent living at home. And even those who do eventually age out of it, the cliff is coming. The only question is when. Now here is the critical connection to everything we've covered in this video. Every dollar sitting in a traditional IRA or 401k, every dollar that hasn't been taxed yet, is going to surface as income eventually. For the surviving spouse, it surfaces as ordinary income stacked on top of Social Security, stacked on top of investment income, stacked on top of whatever pension or part-time work they have. And it surfaces in a tax environment that is measurably more punishing than it was when their spouse was alive. The widow's penalty doesn't just hurt the year it hits. It compounds every year the surviving spouse is drawing down retirement assets as a single filer. Are you already navigating this and filing single after losing a spouse? Or are you watching this while your spouse is still here trying to get ahead of it? Drop your situation in the comments. It changes what moves are available to you. And I want to help you understand which conversation to have next, because the moves, the ones that actually change what Carol's tax bill looks like, the ones that change what Sandra's children inherit, those are coming up right now. And every single one of them has a deadline that is not a date on a calendar. It's a heartbeat. Everything I've shown you so far, the 10-year inherited IRA bomb, the annuity with no step up, the half reset on the brokerage account, the widow's penalty compressing every bracket, none of it is inevitable. Every single one of those outcomes has a legal IRS approved move that changes it. But every single one of those moves has the same deadline. While both spouses are still alive, let's go through them. The first move, and I would argue the most important one for most people watching this, is a Roth conversion. A traditional IRA or 401k is a tax time bomb with a 10-year fuse for your children. Every dollar sitting in that account will eventually be taxed as ordinary income, either by you during your lifetime or by your heirs after you're gone. A Roth conversion takes that dollar now, pays the tax at today's rate, and permanently removes it from the ordinary income machinery. Once it's in a Roth, it grows tax-free. Your heirs still have the 10-year rule, but the distributions are tax-free. The bracket bomb is diffused. Here's the question a Roth conversion actually asks. Do you want to pay taxes on this money at your rate while you're married, while you have the full standard deduction and the wider brackets? Or do you want your children to pay taxes on it at their rate, stacked on top of their income inside a 10-year window they cannot control? For most people in the 55 to 68 range who are still in a relatively low bracket before RMDs kick in, the math strongly favors converting now. You don't have to convert the entire account at once. You convert in layers, enough each year to stay inside a bracket you're comfortable paying without tipping into the next one. Do it for 5 years. Do it for 10. Chip away at the pre-tax balance systematically while both of you are alive and your joint brackets are still wide. And here's the piece most people miss. Every dollar you convert to Roth is a dollar that will never count toward IRMAA. Never push your surviving spouse over the Medicare surcharge threshold. Never force more of their Social Security into taxation. The Roth conversion doesn't just help your children, it helps the spouse who outlives you. The second move is the spousal IRA rollover. And if your spouse has already passed and you haven't done this yet, stop this video and call your plan administrator today. When a surviving spouse inherits an IRA or 401k, they have an option no other beneficiary has, rolling it directly into their own IRA and treating it as their own account. Their RMDs don't start until they hit 73 or 75 if they were born in 1960 or later. They are not a beneficiary on the 10-year clock. They are the owner. That distinction is everything. Your children cannot do this. A sibling cannot do this. A trust generally cannot do this the same way. Only a surviving spouse. And it is one of the most valuable provisions in the entire retirement tax code. But it only works if the beneficiary designation is correct and the rollover is executed properly as a direct trustee-to-trustee transfer. Which brings me to the move that costs nothing and that almost no one does on schedule, reviewing your beneficiary designations. This sounds administrative. It is not. If your IRA names your estate as beneficiary instead of a person, whether by accident, by an old document that was never updated, or because someone told you it's simplified probate, your children lose the 10-year rule entirely. The IRS drops them to a 5-year mandatory payout window, higher annual distributions, higher annual tax hit, more bracket compression, all because of a form that was never updated. Pull your beneficiary designations tonight. Every IRA, every 401k, every annuity. If the estate is named anywhere, fix it. If an ex-spouse is named anywhere, and this happens more than anyone admits, fix it immediately. The fourth move is annuity spousal continuation, and we covered the mechanics earlier, but I want to say it plainly one more time. If your spouse dies and leaves a non-qualified annuity, do not take the lump sum. Do not let the insurance company send you a check. Step into that contract as the surviving owner. Maintain the tax-deferred status. Control when the distributions happen and how large they are. That option disappears the moment you accept the payout. It cannot be undone. And the fifth move for those of you in Alaska, Florida, Kentucky, South Dakota, or Tennessee is the community property trust. We covered the mechanics in the brokerage section, but the action item is simple. If you have significant unrealized gains in a joint taxable account and you live in one of those 5 states, talk to an estate planning attorney about whether a community property trust makes sense for your situation. The double step-up it delivers can eliminate a capital gains liability that would otherwise follow your surviving spouse for the rest of their financial life. 5 moves. None of them exotic. None of them illegal. All of them time-sensitive in the same direction. They require a living spouse. The Roth conversion, the beneficiary review, the community property trust. These are conversations that need to happen at a kitchen table, not at a funeral home. And if you found this video because someone sent it to you, the child, a sibling, a friend who thought you needed to hear it, that person did you a real favor. Share it with someone else who needs to have this conversation before they need to have it. I want to go back to Sandra. When Gary died in March of 2023, Sandra did the spousal IRA rollover correctly. She rolled his 401k into her own IRA, deferred her RMDs to her own age, and bought herself years of additional tax-deferred growth. That was the right call, and she made it. What she didn't know about was the annuity. Gary's non-qualified annuity, $280,000, $180,000 of it in accumulated gain, paid out to Sandra's eldest daughter as a named beneficiary. Sandra had assumed, the way most people assume, that the step up in basis would reset the gain at Gary's death. It didn't. Her daughter received a tax document showing $180,000 in ordinary income in a single tax year. Stacked on top of her existing salary, she was pushed into the 32% federal bracket. Combined with her state income tax, she kept roughly $120,000 of a gain that had been compounding for 22 years. Gary never meant for the IRS to be the largest beneficiary in his family. He just didn't know. And no one warned him while the window was open. Here is what Sandra is doing now. At 71, filing single, she is doing Roth conversions on her own IRA carefully each year, converting enough to stay inside a bracket she can manage, reducing the pre-tax balance that will eventually hit her own children's tax returns. She is doing now alone what would have been far more powerful to do with Gary together, when both their brackets were wider and their joint standard deduction was nearly double what hers is today. She is doing the right things. She's just doing them with half the runway she would have had. If you are watching this and your spouse is still alive, that is the only fact that matters right now. Not your account balance, not your state, not your age. The fact that your spouse is still here means every single move in this video is still available to you. The Roth conversion window is open. The beneficiary designations can be fixed tonight. The community property trust can still be established. The annuity spousal continuation can still be planned for. Every door is still open. The day that death certificate is signed, most of those doors close permanently. The IRS does not offer a grace period for people who meant to get around to it. So here's what I want you to do this week. Not eventually, this week. Pull up every IRA and 401k you own and look at who is named as beneficiary. If the estate is listed anywhere, call the plan administrator tomorrow and get a change of beneficiary form. Look up whether your state is a community property state or a common law state. That single fact changes how your brokerage account transfers at death. And if you have not had a conversation with a fee-only financial advisor about Roth conversions, no, not a broker, not someone selling you a product, a fee-only advisor who works for you, that is the first call you make this week. The information in this video is educational. The action has to be yours, but the window is open right now and it will not stay open forever. Gary Hutchinson did everything right. He saved. He planned. He named his beneficiaries. He just never had the conversation about what happened after. His daughter kept about $120,000 of a $180,000 gain. The IRS collected the rest, legally, automatically, without a single phone call. That is not a story about a tax code that conspired against one family. It is a story about a window that was open for 38 years and closed the day Gary died. Yours is still open.